Everyone. Welcome to IPP webinar. And if I hope my microphone is clear. If it's not clear, maybe my administrator, Hiroshi, let me know if it's okay. If it's okay, I will continue. I'm going to share screen so you can start tonight's session. So I'm going to share screen right now. Sharing. Okay, it should be fine. Thank you once again for gathering tonight. I know all of us are busy, and that's why we use Zoom. I think Zoom is probably the most convenient. You get to just come in, go out, have a cup of coffee. If I'm not talking sense to you, probably switch it off. So it's all good. But can we say that we are very appreciative of your time because, as you can imagine, all of us are very busy. And for you to carve out this an hour or an hour and a half, it's quite, we're quite thankful for that. And because we're thankful, we want to make sure that our, at least the content, whatever we deliver, will be something that is useful to you. And we really want you to benefit from it. So at the end of this talk, there will be a Q&A time. I really appreciate it if you could just ask the questions that you want. The reason is, as you can imagine, there's so many people, so many of you out there, people have different needs, and you probably have different things you're looking for. And it's most likely that I will miss some things that you're looking for. So if you could fill in the information gap that you're expecting, you're not getting, ask the question, and I hope that in the Q&A, I'll be able to address that. And that will make at least tonight worthwhile for you. Okay, so without further ado, I shall start the seminar. First of all, of course, disclaimer is so important because we want to set our seminar right. The right setting, the right conversation, and the right takeaway. If I can read to you, the information and opinion contained is provided purely as a guide, and all potential investors are strongly urged to verify the financial information to satisfy himself or herself, which means you, of its accuracy and completeness and suitability of investments for your investment purposes, needs, or requirements. So important, right? Because all of you may have different investment needs. Sometimes what we say may not meet that. So please double check that first of all, the accuracy and thereafter suitability to you. IPPFA's directors and employees may have positions and investments referred therein. They may be, but I'm not going to suggest anything other than market talk anyway, but at least this for you to know, may affect transactions of the same at any time, just in case that we all buy the same, funds or whatever. This presentation is not a legal contract, nor its content constitutes or form a part of, and that is made in connection with any offer, invitation, or recommendation to sell, or issue, or solicitation of any offer to subscribe or purchase or otherwise acquire any of the instruments referred to therein. And neither this presentation or anything contained in it shall be form a bias of or be relied upon in connection with any contract or investment decision. So it basically tells you that please, there is no intention to make your buy a certain thing. It's just information. Very quickly, I still need to go through this. You should make reference to all relevant documents from designated investment providers and seek relevant professional advice. In this case, our advisors who invited you before making any investment decision. So important. Again, back to what I said earlier, because you have different investment objectives and all, please talk to the advisor that invited you, because they're very competent, because we train them and we keep them updated every month. Because while you're doing this every quarter, we're doing every month, so they know what's going on and they probably give you the most appropriate advice according to your needs. Okay, very quickly, in the next slide, it tells you also that, wherever we speak here, we have the rights to broadcast it, to market it, and so on and so forth. So I hope that that gives us the broad coverage of what we are doing today. So it's a talk, it's a presentation, it's an opinion of how we see the market, and hopefully you benefit from it. Okay, the program goes like this. First of all, I have to give you the market update, right? So that is what's going on. So we keep up to the speed, at least as of at least end of last month. Of course, we certainly have to talk about the big elephant in the room, right? Which is the over the weekend, the unfortunate, attack on Israel, and whether it affects the market or not. Although I touched very briefly on it, but basically I want you to focus, which is the second part, which is getting ready for 2024. Of course, we spoke about the Q&A that will come after my slides. Okay, so very quickly, I will go straight into our market update. First of all, market update. We have to talk about last month, right? So this is last month, September. Market in general has been soft. It's mostly negative. So what I've listed, you see the chart out there. The green is S&P 500, which is US. NASDAQ is more of technology and healthcare. You know that. The blue color is Euro Stock 50. It's hopefully a representation of Europe market. And then you have MSCI World, which combines all the Asia Pac, as well as Europe, as well as US. Then you have the blue line, which is the Asia region, and then you have STI for local flavor. So you can see Singapore is doing very well, but that's only this month, right? But we need to know what happened since the beginning of the year, and this is how it looks like year to date. Whoa, look at that. NASDAQ has gone straight up there, at least 25% performance, but that is outlier. As you can see, the rest are struggling at about 10 below. But this as of end September. Okay, so market since then has softened a bit and rarely past few days. Yeah, so that's where we are. So you will have a question, right? The question is, wow, Nasdaq has done very well, and the red is STI. Oh, it's done poorly. But I've always tell my advisors and all. Sometimes it's always good to know what came before this year, so you get a better picture. In other words, it's good to zoom up to have a more holistic view, and therefore the story unfolds better. So if you could allow me to bring you to last year, what happened last year, how 2022 ended. Oh, wow, look at that. Just as I spoke about NASDAQ, how it outperformed, it underperformed in 2022. So in some sense today, this year, 2023, has got some extent a rebound from a very poor performance last year, and this year it performs very well. So it's sort of like a catch up, if you were. So it's interesting, right? So I think for those who are watching this and looking very carefully, you'll notice something else, the red line as well. The red line has done well, and that's what this red line is. It's Singapore, isn't it? It is Singapore has done well last year. But if you recall my previous slide, Singapore hasn't done well this year. So you can see the reversion to the mean at both extremes, the Singapore STI in this case, and on the flip side, we have your NASDAQ. So this is how it looks like this year. If you could just toggle your mind, how STI has done that well, and also if you put so how does it work out? You put two slides together. So as I'm going to show you, as of today or as of end of September, how it looks like over 2 years. This is how it looks like. Now, it tells a better story, isn't it? That's why I love charts to the extent it tells a story, and it's good to learn the story. The more we learn the story, the more we are equipping ourselves to further bolster our defense against ups and downs of the market, or even in a newspaper when they talk about, NASDAQ is doing very well, and you feel bad, but you need not feel bad because the year before it did poorly, right? If you missed out on NASDAQ this year. Similarly, if someone say, Singapore is bad this year, or STI is bad this year, but if you were to stretch out in 2 years, look, in this 2-year chart, STI has actually done pretty well relatively to the rest of the indexes. So, we can go on by zooming up, more and more from 3 years, 2 years to 3 years to 5 years, but you get the story. The story is that for us to better to understand the market in a more holistic way, it's always good to zoom in and zoom out, zoom in and zoom out. So take a look in, and with that, this moving in and out will help you better, see where the market is and all the events that occur during this time and how it affects them the individual markets. So that helps you to understand it better, and that's how by understanding better, I hope that you can invest better. I'm sure you will. I'm sure it does, right? So let's move on to the next slide. Okay, the next slide here, it's actually numbers of what we spoke about, because, chart is one thing, chart sees trends, charts will tell us the story, but numbers at the end of the day tells us precisely where we are at the moment. Certainly for those people who love numbers, this is what it is today, year to date, this year. At the end of September, S&P is about 11.7. Dow Jones, which is, industrial heavy, it's 1.1. Whereas for NASDAQ, which is your tech heavy and of course healthcare heavy, you see outperformed this year. So S&P, if you were to take a look at US, represents a broader market. But of course, I think some of you who have been touched on the market will know that most of the movement nowadays is moved by the larger cap in S&P 500. So the small caps are suffering, but the large caps are moving forward. But it tells a lot of story. One of the underlying story about large caps and the index movement has everything to do, listen to this, everything to do with ETF. ETF fund flows have been flowing into the index-linked ETFs increasingly at a much faster rate than normal funds. Why? So because people sometimes don't want to think too much, and probably fund managers do disappoint once in a while, and therefore they say a resort to just working on S&P ETF. So they do that. So they start putting, when more people buy the ETF, the underlying ETF will have to buy the S&P 500. I mean, the main shares listed in S&P 500. Therefore, the index components will be bought, and therefore there is a support to index components. So it's a big deal for stocks to get into index component, because there's an underlying support in terms of people buying into ETF, which mimics the index. So I hope, in this short explanation about why there's a support of index-linked stocks will help you. Okay, so this is what it is. These are the numbers. Europe, as you can see, still positive, Europe, except for FTSE. Again, if you broke the FTSE down, well, it doesn't perform this well this year. That last year it did better than the rest. So there's a bit of a mean reversion again. I mentioned earlier, it's happened if you look at the individual stocks relative to others in Europe. So that's Europe. What about Asia? Asia is this. Whoa, look at that. Nikkei has got 22%. Don't you wish you were in Nikkei, right? But then again, if you go into Nikkei, you have gotten into Forex problems, right? So what is the yen to sing now today? Man, it is really, really cheap. It's one of the cheapest time to go to Japan. If you have not, please think about it. It's 109 as we speak today. I just took a quick check. It was 109. Of course, when we really do the exchange, you won't get 109, but close to 109 you can get. Guess what? What a wonderful time. I don't know about you, but I like Japan. That makes me think of going already. Will it burst to 110 for Sing to the yen? Is anybody's guess? It can be. It's most likely we hit it before it pulls back. But it does look like it's a threshold that the traders and all want to try to breach. But to us, if you invest in FX, you're probably very interested in it. But if you're interested in me, like a holiday, then yeah, Japan is a good spot, especially the Forex. But investing in Nikkei, you will have been compensated in terms of your losses if you if your yen that you hold has gone against your thing, but the yen itself, the market, have gone up, sort of like compensate a little bit. Shanghai is flat this year, 0.7. I call it flat. Hong Kong is bad. Of course, you know story about Hong Kong, about China versus US competition. Therefore, it's affected. Taiwan is strong because of tech. Korea is strong as well because of tech again, and so on and so on. So by and large, Asia, you know, they're slightly positive. So with that, this is using MSCI World to give you the regional performance of first of all, MSCI World. So if you invest in MSCI World, which our model portfolio, Eagle Eye, does that, you get roughly around 8% thereof now. For US, if you focus on just US, you should go about 12. Focus on Europe, you should go about 6. And of course, Asia is slightly flat to 1%. There you go, slightly still on positive, but that's Asia. That's your performance year to date. If you were to look at the shares by itself. Now, what about bonds? Bonds is what it is because we need to show you our bonds because most of us do not invest totally into equities, right? We have got bond components. If you're a conservative on a conservative portfolio, you know that 80% of your portfolio is in bonds and 20% is equity. As you move up the risk chain, you're moderately, if you're moderate on a moderate EGI portfolio, you see 60, 40, 60 being the bonds portion, 40 being the equity side. So bonds is important, this is the performance. Unfortunately, this year, again, year to date is negative. The yields are continuing to push higher, slowly but surely higher. And therefore you say, but it's not as bad as last year. But indeed, it's still, as of today, as we speak, the ETFs are underperforming. Okay, so there is a reason why I'm showing ETF instead of index. Index is very, very difficult to achieve. In other words, the nature of the index, how the bond index presents itself is very different from equities because there's a bid and ask in the bond side, and it's not, and it's marked always at either the bid or the ask, but it's never at as opposed to equity, it's not at the last done price. So there's a bit of difference, but because of difference, unfortunately, if you were to try to follow the ETF, you would always be losing out on the spread. So ETFs will always, bond ETFs will always underperform the index. Say that again. For those who want to know, I've been following bonds, you always wonder how come you buy into any ETF, bond ETF, by yourself, you realize that you're underperforming the index. You wonder why. Don't blame the fund itself. It's by nature of the index and how we buy bonds and how they price the index. There's always a gap. Okay, so I hope that helps, especially when we want to look into bond ETF. Okay, next slide. It tells you that, so with that, with the bond side, I want to move back to equity. And if you were to take a look at the slide for this year so far, you'll notice something. You'll notice that the market seems to be range bound since April 2023. Why am I telling you this? I'm telling you a story because this story will equip us to further understand what will happen, what is likely to happen, not will, but likely to happen in 2024. This is the whole aim of today. Today, I want to help you all to prepare for 2024, in a manner which, at least when you enter 2024, you won't be, what's going to happen, you wonder what's going to happen. At least you have certain expectations, certain events, and with these events, how it unfolds, it will likely affect the market, so on and so forth. So I hope that tells you or prepares you for 2024. So it's interesting, this part where equity seems to be range bound since 2024. I brought this chart here. I've taken off NASDAQ because it skews my chart, but I've got this as the general market. As you can see, I'm going to draw some lines and you'll notice that it is, it is range bound. This is the upper range and this is the lower range. And it happens that after April, it seems to be like going up and down, but it is around this range. And there's a reason for it. And the reason is this range-bound movement in the market suggests that there is a waiting for the conclusion of a fight against inflation. Say that again, this range-bound movement suggests that there is a waiting. People are waiting for conclusion to the fight against inflation. Okay, for those who don't know, we're in the midst of fighting against inflation. And last year, you see the peak there, there's US, but of course Singapore is the same. There are all over the world. Last year was the inflation was shocking, and this year is still high, by the way. But then again, we came up. But the feeling, not feeling, but factual rise in our cost of living was felt last year, and was peaked in the US. It peaked in the US about 9.1% in June last year. So it's not easy. So that's the fight. Now, the reason for the inflation has everything to do with COVID. You know this, but what are the economic reasons behind it? Economic reasons is this: because what's COVID? You guys know this. The government, it's worried about the economy because it's shutting down, and they have to do something about it. One of the things they did was, in the US at least, they poured $5 trillion in the economy by government alone. Say that again, 5 trillion, not million or billion, but 5 trillion dollars of money is poured into the US economy to keep it afloat during COVID. And not only is it government spending of about 5 trillion, so more than that, slightly more than 5 trillion. That's also about more than 4 trillion of monetary easing by the central bank of the US called the Federal Reserve. So you have about over $9 trillion being released in the economy. Guess what will happen? Certainly, so much money is rushing for the same amount of goods. Guess what? Inflation zoop goes up. So that's what happened. Inflation goes up. That's on the demand side. Of course, there's a money supply side, which helps the demand side. But on the supply side, I think COVID was a problem. COVID did constrict supply, and therefore, low supply, high demand. Your economics 101, price will go up. So that's what happened to inflation. And in the fight of inflation, the US has increased its interest rates. We know that. But the fight is ongoing. Said it again, the fight is ongoing. You notice this chart here? We have not gone down back to the 2% level, which is what the Fed is hoping to achieve. Now it's 3.7 in terms of the general CPI. The core CPI, which strips out the energy and food, is on the downward trend, but it's still not 2%. At a 2%, you can see pre-COVID the level that they want. So in other words, we're still in the middle of this fight, and therefore people are waiting to see who wins or who loses. The ups and downs, therefore, within that range represents the ebbs and flows of positive and negative sentiments to what? To information flow. Sometimes information flow comes up to be positive and everybody's happy, and everybody comes out, it's not good, everybody comes sad, kind of thing. So it moves up and down. So this is how it'll look like until there is a conclusive point to the ending of this inflationary fight. It's not easy. We know that because it's tough to especially figure out the impact of the economy after pouring so much money in the economy because of COVID. And COVID is once in 100 years, right? So nobody has done this before. It's unprecedented. So we are also living an unprecedented amount of supply of money, and that's what we are feeling as well. Okay, so that's that. But if you also notice, and then by now that we talked about September, right? It's soft, right? So the current softness in the market is a result of a combination of a technical price resistance and fundamental news. Let me explain. So for technical analysis, okay. So now why I'm going to break it down. This is technical analysis and fundamental analysis. At IPP, we look at the market in 3 ways, and this helps us to decide how the market, what we think of the market. Certainly, for technicals, it's basically charts. Charts does give us a lot of things, but mainly it does give us the sentiments of the market. And it's very important to figure out sentiments because human are sentiments, and we are sentimental, and our emotion does express itself in the market. And it's all good. It is what it is. So we do that. We take a look at the technicals. But of course, fundamentally, it also girds our explanation of what's going on, which is the economy and so on and so forth, macro economics and all. So we look at these two, and finally we have this thing called quantitative analysis, which sort of guides us how deep the fall, if there be a recession, how deep how deep the fall of the market can be, and of course thereafter the recovery. So all these three we use, and right now I'm just explaining to you a little bit using technical or charting to figure out what's going on as we experience the market today. So we had a good run. We did. We had a good run of 4 months from March to end July. Straight run. Why March? I think you know. We had a pullback because of the Silicon Valley Bank. Remember? Yep, that's the word. That's the bank which mismatched its assets and liabilities, and therefore got itself in trouble. And I saw panic everywhere. People think it's another global financial crisis, but it's not. It turned out not to be. It's just turned out to be company-specific issues. It's not a sector-specific issue, and certainly not a market-specific issue. So all good that it's compartmentalized into company-specific issues, and therefore the drop, and therefore quickly recover. So 4 months run, you can see that. But in all things, like I say, as technical settlements, right? Emotions. After a while, you're up too much, you want to take a breather, and that's where a breather is. That's why you pull back from the highs of the early days of August, and that's where we are today. But technical doesn't tell just the story. What about undergirding fundamental reasons for it? The recent peak, somehow, if you think about it, coincides with the last interest rate hike of the peak of the expected terminal rate before a pause. Okay, long sentence. What I say is that in the fight against inflation, the Fed will raise its interest rate so to cool the economy. So in cooling the economy, it wants to pull down the interest rate, pull down inflation. So the interest has to go up to a certain point where most people think that is enough. That's what you call terminal rate. That is enough. That is enough to fight it. So people expect that, and it happens that the market turned the moment we hit the peak. It's quite fascinating. So as you can see, this is the run-up, and at the peak, coincidentally, it's at end July. You notice that what I've showed you is a table of federal funds rate, how they start to increase the rate in fight, the fight against inflation, which is starting in 2022, March 2022. So there you go, 25 basis point. We read from the bottom row up to the top row. You can see slowly, gradually increase the interest rates. These are the interest rate range. You can see it move up. So July 26 was the last raise in the change in interest rates, and coincidentally, that's the time where markets start to fall back. This chart here, source from Bloomberg, tells you the market's expectation of the peak at different months, if you will. So you notice that the two lines there, and they're about the same, right? So in July and August, there's no change in expectation. So everybody's expecting that. Everybody expecting that at end July, that the market will, the interest rate will peak. There you go. That's where it was. So people think that's so. Because people think that's so, that's where the problem lies, right? So the problem is that with the rise in stock market during this time can be attributed, of course, to the approval. So it rises so because approval is fight against inflation. It's ongoing. First thing that's going to win, right? So you raise the interest rates, inflation comes off, yay. So the problem is when you stop, doubts, see, it's again human, right? Doubts of success of a spike begin to creep in. You say, hey, maybe not, Then look at some information flow in terms of data that presents itself along the way down the line. Guess what? I think it may not be successful. So I think that another 25 basis points is needed. So that's it. Emotions, we will have doubts, and doubts, creep in. When doubt creeps in, so the market retreats. So it did not help also that the latest FOMC means the Federal Reserve, that they call themselves FOMC meeting, which is the latest last month, that the Fed indicated they too fear that the inflation was not fully under control. Whoa, okay, it's not only the market feels it, but the Fed seems to feel it. Now, how's that so? Okay, this is a dot plot. For those who have been following us, you know, once in a while we'll show you this. This is I just took a snapshot of the report that they gave to public of the meeting that went on among the Federal Reserve governors, and this is a dot plot where all the governors have to indicate where they thought the interest rate should finish at the end of each year. Say that again. The dots represent one single vote of the many governors that comprise of the Federal Reserve, FOMC, and they will have to, in their opinion, where the interest rate will end of the year. So this is what it looks like. So conveniently, because you can't see the numbers at the bottom, I have typed it out for you: 2023, 2024, 2025, 2026. So this is the graph that spooked everybody. Why? Because the current rate is where the red arrow is, which is, just below 5.5%. But you notice that more governors think is above that. So in other words, hey, most governors think that is not quite done yet. And therefore, we want to put a insurance there that you may want to move it up. And that's where it spooked to the market. So immediately after that, the market responded, right? So remember just now I saw the same line. This is the same, just that the dates of the lines are different, right? So that one was July and August, and now I've got September. Look at September. Whoa, okay, things have moved, right? So market has adjusted according to what the Fed thinks. In other words, the fear start creeping in a little bit. So that, I hope, gives you a background of how we are moving on to 2024. So important is where we arrive at this point. So, so very quickly, getting ready. Okay, so with that backdrop, now it's time for you to get ready for 2024. I know it's only October. I totally understand. And we just got into the last quarter. A lot of people, a lot of fund managers and all talk about last quarter, what's going to do in the last quarter, what's going to happen, and so on and so forth. Unfortunately, for us, we believe for your benefit, your mind has to moved already from end 2023 to 2024. Now, why? One of the main reasons is that, when someone buys into a stock at today's price, it builds in forward-looking expectations. Forward-looking expectations, actually not the end of this year, but forward-looking expectation has a lot to do with 2024. In other words, most people that do their business now, suddenly before Christmas, they want to get it all done. It's for 2024, positioning themselves for 2024. So I hope that we are a bit early, but I hope we can prepare you to think about and prepare for 2024. And should you do anything to your portfolio, and we advocate that, stretch your horizon slightly longer. Instead of looking at 2023, you start pushing forward to 2024. Now, the reason why we think you can do this is that the performance of 2023 is very much done and dusted, barring near-term geopolitical climate or medical crises, right? So it's very much done and dusted. Why do we say so? Remember this chart we showed you about earlier on, and this performance here. So it is roughly that, and the range bound that we spoke about is roughly that, because it's unlikely there will be a lot of economic reasons for the market to move beyond its around this price. So if you want to know how you perform this year, look at now. It should be around there. It may not be exactly this, but it should be around there. Again, market likely to trend in a range bound from here at the end of the year. So that's your performance thereof, not exactly thereof. Okay. So you start looking forward. Now, however, as much as I say it's range bound and all, well, there is, of course, things that economically, we can't explain. We just have to say these are the risks, and these risks are near-term risks such as geopolitical, climate, or medical crises. And what are they? Some of you are already watching the US. There's the workers' strikes. Now, workers' strike it's a big year, right? This year for the labor organizing strikes, in the US, from auto lines to auto production lines to healthcare to Hollywood. So right now, the auto workers are beginning to strike against General Motors, Stellantis. Stellantis is Citroen, right? So yeah, no, sorry, it's Fiat. It's Fiat, and also and Ford as well. So these are happening. So does it affect the economy? Yes, because of the strikes means that the production of the US auto industry drops. I know it's small here and there, but you never know. When one strike after another, you basically, it can pull down the economy of the US if the strikes go out of control. So these are near-term risks. Right now, it's still not significant, but prolonged one does appear may affect the US economy. If it comes together, a few factors together. And so small, 10 small become one big, right? So watch that. Government shutdown, this, the US House and Senate managed to have a short-term funding deal which pushed it 45 days forward to 17th of November, and they will fight again. This whole see, look, all small things, right? So if this government shutdown and then a strike has all sorts of things, it can happen. All these little things can move from the range bound performance that you have, but we need to know that. Okay, so of course, gasoline prices are another one that pushes the oil prices up above $90. Latest was 86, but not today. Today I difficult to see, but I think it should have gone up a little bit more already. So stand corrected. This slide I've done I done it 2 days ago. Yeah. So I don't know what kind of price now, but that's what it is. So in other words, oil price can be a surprise, right? Look at the crisis now that we have in the Middle East. If it really push up to $100, I think we're really in trouble. Or $120, we're really in trouble. So these are near-term risks. Russia and Ukraine war, we know this, is approaching without any irrational decision to gain an upper hand before the war. We should probably use very heavy weaponry, may have terrible blowback consequences. So let's hope that doesn't blow up from where it is. We already opened two fronts of trouble already, right? Ukraine and now the Middle East. Okay, this one, I wrote this, last beginning of this year, this month, actually the last week of last month, because we had this talk for the advisors. We think there is we guess that look, the Middle East is always a problem, and true enough, it popped up. Okay, not that we expected. We say it's a known risk, and we have to talk about known risks. So we need to prepare you for known risks. And one of known risks is Middle East. Middle East always have this issue. And there you go, Hamas attack on Israel. That was only last Saturday. So it's so sad. I don't know whether you guys are watching the videos and watching the whole thing. I mean, it's totally sad. I don't know about you, but now that Israel have to attack Palestine, it is not a good idea because lives will be lost again and all this stuff, But what can we do as investors, as us? We can only say, look, how do we prepare ourselves for it, right? So we're going to prepare you for it. We're going to give you an opinion of how it looks like and what's going on. So when you understand the whole big picture, it helps. Now, remember what I said about known risks? Now, when there's a known risk, the market usually reacts less adversely than an unknown risk. And also unknown. Those things we don't know. What is an unknown? Unknown is, if you could allow me to use the COVID-19, is that pandemic. Pandemic is unknown. Seriously, people think, that won't happen to us. Even we got modern technology. Last time it happened was Spanish flu. Hey, during that time, they're not as advanced as us. Now we are so advanced. How can it happen to us? But guess what? It can shut the whole world down, right? It's called unknown. So it happens. So unknown is something. The other unknown was the GFC, global financial crisis. So live through it, it was an unknown. And unknown in the global financial crisis is that the market reaction is worse than that of a pandemic. And you wonder why. One of the many reasons is what we call financial system. The financial system, the banking system was at risk. Say that again, was at risk during global financial crisis. So that's why it went to 50% in terms of the US market. But for pandemic, it only went down to about cost about 30% and went back up. So financial system is so important. Of course, in this case, it's intact because of pandemic. That's why the drop is not as severe as global financial crisis. But back to what I'm trying to say, known unknowns and unknown unknowns. Because when it comes to known unknowns, you'll see the reaction is milder than a unknown unknown. So the next slide I want to show you as of today. So I asked my staff to print out today is as of last night, in other words. So what you get is your SDI, you get your euro, and you get, hey, well, why are they moving up? That's the thing. What's going on? It's strange. It should be troublesome, right? Why is market going the other way? You should be going off. It's important to know that. Remember, I said about known unknowns, so you know about it. And I think currently, as the situation seems to be contained, not to say it won't be contained, like, who knows, right? Things can happen, like maybe Iran will join in the war, kind of thing. We don't know. Okay, but as of today, as we speak, I think investors around the world, things still contained, and the world can still move on, while having unfortunate spectating of the war. But in the meantime, equities go up. Why? Now, it goes back to a financial mechanism in the system, because investors are seeking safety in bond market. When they seek safety in bond market, means that they're buying more bonds. As they buy more bonds, they drive the yields of the bond down. So, right, demand and supply. The more people want to buy, the more expensive the bond is. I think you know the inverse relationship between the price and the yield. So price go up because there's a lot of demand, and therefore the yields come down thereof now. Should things worsen the geopolitical front, there's more likely declines in the bond yields, right? So strangely enough, lower bond yields is positive for the stock market. Said it again, lower bond yields is positive for the stock market. Fascinating, isn't it? So, so just like you want to bet against the stock market, it goes back up. So guys, please, near-term trading in the stock market, you're really very good at it. Okay. I've seen enough stock market respond in very, very unique ways, in certain ways that you don't expect it to. This way, it goes the other way. So, right. So those stock traders, you'll know. Anyway. So also, the reason, of course, for what's happening in the lower bond yields and therefore stock market going up is also because the comments from Federal Reserve just this week, indicated that the Federal Reserve may be done raising interest. Remember, I told you about dot plots and saying that there's another way the more people think. So, but that was September, right? So now 2 weeks later, and news flow coming and say, oh, more people don't think so anymore. And then there you go. So maybe a peak, who knows? Then again, remember I said we're range bound. When we're range bound, it moves the ebbs and flows of information flow. If it's positive, happy market will go up. It's not happy, it's not positive market, it will come off. So we gotta expect more of such things to come about. Again, ebbs and flows, ebbs and flows. So the other risk that we need to watch out for is climate change. I think natural disasters can derail economies, earthquakes, floods, tsunamis, and hurricanes. For those who remember, just like me, very clearly, as clear as day, how the tsunami hit Japan and really had issue because it was a nuclear scare. Okay, so guys, even though sometimes it's maybe simple floods, we don't know what the knock-on effect of the terrible flood, the terrible earthquake can be, and therefore we have to watch and see. These are natural disasters where we don't know whether it will come, whether it will not come. But December usually there's earthquake and all these tsunamis and all, and so we don't know. We'll wait and see. So there you go. These are risks that we need to watch out for. And finally, not to belabor on more risk to the near-term performance of your near-term end of this year performance will be another medical crisis. Although it's a very unlikely in my view. I know people say it can be happen, but I just put it out there for completeness sake. Look, okay, this is my personal view. There was when it occurred twice once in every 100 years, at least in terms of pandemic, I believe statistically it's more likely that in the next pandemic it's gonna come another 100 years. Okay, it is just the way I rely on statistics. Okay, you are just as correct as me saying otherwise. I mean, so that's my personal opinion because I love statistics. It helps me to guide me in more areas uh, than not into better decision making because of probability. Okay, then now that we know near term, that are the little risks that how your performance should roughly end where is this today? What lies ahead 2024? And how will the market respond to these events? Let's check them out. First of all, if you can allow me to say that the battle against inflation will continue. Say that again. The battle against inflation will continue in 2024. It's not done, like I mentioned also. Remember what I told you that we need to know what came before us, and therefore we can better understand what comes ahead of us. Guess what? What ahead of us is still what we are still battling, which is the inflation. There is no clear sign. Let me explain a little bit. In the same release of FOMC minutes, of the same graph, this tells you the projections of what is the interest rates, this inflation that the Fed see. So you have this range. The Federal Reserve governors will just indicate what they thought the end of the year looks like for inflation for the US. 2023 is the elevated. 2024 looks so important to look at 2024. Okay, why where's 24? The green arrow is where 2024 is, because the Fed does not believe they're done with fighting inflation until it reaches 2%, which is the line I've drawn. It needs to get there. Guess what? Most people, at least the governors, don't think they can get there by then. In other words, the fight will continue. They may win, they may not win so soon. The tug of war continues in 2024. So what does it mean? Please stay on the lookout for data that says they are winning against inflation, data that say they are not winning against inflation. This will indicate the ups and downs of the market. So that's one thing you may want to take note of. So because of the inflation figures that say it's not quite the 2% that they want, the interest rates that they will they think that they will employ or make benchmark for 2024, which is again the green arrow, will be, hey, look, not too far off from today as we speak. Now, this is important. It shows you that the battle is ongoing. They want to keep the interest rate high, so they want to make sure inflation goes down. So what's the implication on us? It's not a dry information, guys. This is not a dry information. It's so important. It's so instrumental what we think. Of course, first of all, directly will be your mortgage rate, right? So mortgage rate is going to remain high next year. It's not going to come down any soon. So you do all your variable or your fixed, whatever, I leave it to you. But it's what it is. But the good news is it's lower than today. Say that again, it's lower than today. So at least this year you can see that. So it's coming off, but it's still high. Okay, so please, if someone asks you whether it tells you the interest rate will go zooming down next year, you may say, look, maybe not so fast. That's a good answer. Because look, these guys are experts. These are the governors of the central banks. They get together. This is what they say. So who am I sitting on this side of the world to say otherwise, right? So let's take it what they say. Let's take what they indicated as they know today. Of course, these thoughts will change, right? But like I said, we just follow what the experts do, and then it's good enough. It's good enough for us to invest, think of ways how to invest and position ourselves for 2024. So terminal rate also suggests the same thing. The market says the same thing as the governor. So next year, take a look at the chart. The right-hand side, especially, you notice that 2024 is July 31st, 2024. It's still high, it's still about 5%. So hey, as of today, which we speak, hey, that's another 6 months, or rather another 9 months. It's still high, it's still about 5%. So man, we got another half year of high interest rates. So buckle down, don't expect much. This is how it is. So some of you may want to think even beyond 2025. Go ahead, But this 2024 is how it looks like, or what we expect it to look like. Again, expectations comes with probability. It may not at the end, things may change, but today, as we speak, this is how it looks like. So one point to remember, 2024 is the battle of inflation. Second point is that, as we mentioned, the interest rate will be made elevated. Terminal rate will likely be 4 to 5.5%. And while rates are elevated, the start, say it again, quick, listen to this, the start of interest rates declining is positive to the market. Now you know why the market is rallying, even though today, the past 2 days, because the thing that has done, the only thing that's done in front of the interest rates, the market's not looking the next step, right? So market is always ahead. So if you stop at a peak, what's the next step? Is that, of course, you can stretch it, you can pause long, but it's to be going down as a next step. And even if the expectation of down the next step, you see the market so elated in the past 2 days, past 3 days, right? So look, so it is positive, and expect positive sentiments towards end of next year. Okay. Not to mention the end of next year is presidential election in the US, right? So the current government will probably make it feel good and therefore win the election. Anyway, so that said, all this said and done, I have to answer this question because some of you will ask, will the economy tank in 2024, given what's going on? First of all, we need to understand why the US economy is not tanking in spite of the high interest rates last year and this year. We need to understand that. The more we understand it after that, then we can figure out whether the US will go into a recession, because some people are still saying that in the beginning of the year, everybody's saying it. But towards the middle of the year, people are saying maybe not anymore. And now I think more people accept it, that it's a larger probability that the US will just have a soft landing. But that's what most people are saying right now. All right. This is in contrast to the beginning of the year where everybody says it's going to be recession. So, but there's still people who say, look, it's going to be recession, but let's examine it and answer the question why it didn't in the past. And therefore, hopefully, you will make the right decision to figure out whether the same reasons persist going forward. And if it's same reasons persist going forward, then maybe not. Let's see why. All right, let's see why. So this is the GDP. For you notice that there was a technical two negatives, but it's too shallow. That the US economy appears didn't call it a recession, but thereafter, you see 3.2, 2.6, 2.0, 2.4, the latest in terms of GDP growth, is all positive. Hey, it's no, the US didn't go to recession. So one thing people found out, at least people are reporting, and I'm going to share with you, is that interest rate sensitivity. Now, we talk about interest rates go up and economy come off. Yeah, that's correct. But people are saying that could well be, hey, based on studies of the old economy, not the new economy. So what's this new economy? The new economy realized that maybe, just maybe, the interest rate sensitivity is not as sensitive this time round. There is reduced sensitivity of interest rate to overall US economy. So the realization, why? So realization that the availability of credit is more important than the cost of credit. So, sensitivity to interest rate, which is cost of credit, but they realize that the availability is far more important than the high interest rate. So it doesn't matter if it's high cost interest rate, they will figure out how to make the consumer pay. So yeah, so so if just go up, guess what? You pass on to us, people like us, right? Those who are renting, the rents have gone up. Those who are buying food, the price have gone up. Why? Because those guys behind it have having higher credit costs, they will pass on to us. So the squeeze is such on the economy. But that said, the businesses will not go bankrupt. They will know how to do it. They will adjust themselves. So supply credit squeeze is more important than a cost of borrowing. So example of a credit squeeze and a consequent negative effect was during global financial crisis, where there was a lack of supply, so they came off. So this time around, it's about high interest rates. The supply of credit is still readily available, and hence resilience of the US economy has shown up. So another example why interest rates are less impactful, it's found in the mortgage contracts of homeowners. What happened? Now, US, likewise in Singapore, well, not quite Singapore. Singapore is they don't really do a fixed mortgage rate. We don't have that kind of offering, the kind of account product. We have fixed for 2 years after that they go variable, right? Because our banks are very smart. Anyway, so for US, there is this product which fix your 30-year mortgage rate, and most of these people bought it before COVID, and therefore a low rate. So you can imagine, right? For two 2 decades, even at 20 years ago, people bought the 30-year. They're still enjoying the rate then. So they are less likely to feel the impact of higher interest rates today. And let's say they have a disposable income. Their disposable income, they've been paying X amount for interest rates. Even in this high interest environment, they're still paying that X amount because it's locked in. So there you go. That's the reason why they're not so sensitive now. US corporates also, same thing. They're locked into low rates. So low rate sensitivity. Second reason is that the economy is highly diversified. In other words, not one industry overly represents the US economy. So at least the 5 largest industries cover at least 2/3 of the US GDP. Very quickly, I've shown you this. This one tells you that finance, all only occupies less than 20%. So you can see the rest, right? So why is this important? Well, it's important is because the diversification of the US economy lessens the impact on an interest rate shock to the overall economy, because some industries, not all of them, some just do better than others over different phases of time. So you may see one industry that's gone recession earlier than the rest. So let's say, for example, the home builders suffered early, but as they recover, the second one goes down. So this is what we call rolling recession. So rolling recession is something that is covered and now being imputed in the study of the economists of the US economy now. And that's what the US economy is experiencing right now. So it's very interesting, this rolling recession. And this could well be due to also another factor is the US labor force being more flexible. Thanks to the rise in digital economy, we're all experiencing this now. The COVID pandemic struck and workers lost their jobs, or became housebound, but many became self-employed and entered the gig workforce. Gig workforce means, internet and so on and so forth. So in other words, you do not need a job. You don't need a paid employed a job. You can work from home. So you still make money alone. YouTubers make lots of money. TikTokers make a lot of money. They're not even employed by anybody. They just content creators and they get in and they get money. And a lot of people at home do a lot of drop shipping, for Amazon and all. So a lot of things are going on. All these things are outside your traditional employer-employee dynamics. So that's why it's not more resilient to a certain extent. So according to Bureau of Economic Analysis, estimates of 2018, the digital economy covered 9% of GDP or 5.7% of jobs. Probably you can imagine it gets grown larger by now. So 3 things we talk about. The third thing is that US economy in 2024 is likely to be resilient. Okay, so it's likely, it's not will be, but likely. Right. So the other thing also you may want to know or expect, I think we hope you can expect, is that yes, the Fed will be actively managing the economy to a soft landing. Say that again, it will not force it down. I mean, it will to fight inflation, but the aim ultimately is for soft landing. So it's an interest of the US to manage its economy on an even keel. And that's the mandate. They will not let the economy sink without lifting finger. In other words, what happens is that if they were to fight the inflation, push the economy down, people will expect them, the economy, the investors, everybody expect them they'll lift their finger. The Federal Reserve their finger to bring it back up. So when they are done and dusted with the fighting inflation, the Federal Reserves, the US Central Bank will bring the US back to equilibrium. So we expect that. And for those people who have been with us, you know that flashes all the time. But there's a web page of Federal Reserves. It tells you exactly what their policies are. I like the US. US is so transparent in what they do, and people like us as a investor, it helps because I can understand what they do. It's not opaque like China. And China, you can't tell, like, hoping China gives some fiscal policy push, it's not coming and so on. It's not easy to figure out what Chinese are doing, but for US, it's easy, it's transparent. It tells you here, I've blown up big pictures, what the goals of monetary policy is. It states out very clearly they're so to promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. This is otherwise known as the dual mandate. On top of this, Chairman Jerome Powell, in his press conference after FOMC meeting on 19th to 20th of September, says a soft landing is primary objective. Whoa, it is. And it is what we have been trying to achieve for a long time. But Powell's noted that it's absolutely worst thing the Fed can do is to fail to restore price stability. In other words, they want to really control inflation. That's the target, yeah. Make no mistake, fighting inflation is target. But in the event that they fight it and bring about uncontrol, and the consequence is a recession in the US economy, so be it. But they will bring it back up. These are the chess moves, or what we call your game theory, if you will. The people are already expecting it. So it doesn't matter even if US goes into recession. They know that the US Fed will bring it back up so long as the inflation is contained. Yeah. So recession, if it happens, it happens. But people play the next step, which is back the recovery back up. Okay, so that's why he said the record is clear that if you don't restore price stability, inflation comes back, he says, and it'll be miserable to have inflation constantly coming back and the Fed needing to tighten rates again and again. So the best thing to do for everyone is to restore price stability. In other words, low inflation. Okay, so that's what you expect from US. Finally, I cannot finish 2024, talk about Asia. Unfortunately, US, the Chinese economy, we don't talk about it, right? I always ask me, so I got still money in Chinese funds, so what do I do? I'm telling you what the Chinese economy is likely to be. It's likely to continue to struggle unless there's determined fiscal and monetary policy to boost the economy. Okay, the Chinese property woes, we all know about this, this, will continue to impact 2024. And it'll take a longer time for China to sort out its bloated property sector. Is super bloated. Now people are coming to realization that it is bloated. And a rare internal criticism came from a recent ex-Chinese official. He Keng, former deputy head of Statistics Bureau, said that China's entire population of 1.4 billion will not be enough to fill the empty apartments littered across the nation. See how bad it is. Oh man. Okay, but more importantly, the economy is suffering as well because Chinese competition with US sees that FDI drop in China in favor of friend-shoring states. We mentioned about the competition and all, and when you just compete, people do not invest in China, and that's what it is. Today, source World Bank is that the FDI has gone back down to 1990s level. And that's bad. Okay, that's really, really bad. So I think by now, for those who have taken your economics, you would know economics 101 tells us that GDP, the growth of economy has everything to do with the consumption, internal consumption of the people, plus government spending, and certainly plus investments, right? So investment, either internal investment or external investment. So FDI helps. If FDI don't come in, then internally we have to invest. But if the internally people are not optimistic, then what do they invest in? So there is an issue. That's where GDP comes in. That's where the issue comes in. Of course, the end of GDP needs to know your net imports and exports. Okay. So competition with the US will affect a strong export position, right? So friend-shoring and all, I think those. We already read enough already to know that China is severely affected, and most of the US and West at least are bringing essential, critical, security-related manufacturing back to onshore, so they are investing internally. Okay, so this is what it looks like. China's export nearer to us this year, you can see all red. Past year, that's why it's all woes, right? It's getting better. you can see the imports, those are export now, look at imports. It's getting better. I mean, it's not that negative, but so it's good news. So Chinese slowly on the mend, at least imports and exports. But it still takes a long way before it goes, because you need to figure out this the property issue. So not only that, like I said, because of all this war, this economic war with the US, then if China is no longer a factory of the world, who are they factory to? Factory to themselves, but we have so many. So then how, so it very clearly they have a problem. Youth unemployment hit a high of 21.3% in June 2023. Data has since been stopped. So it's really, really scary, right? So unemployment everywhere. So what they do TikTok, I guess. But we'll see. Let's hope China pulls out of it. It's to our Singapore interest, to our interest in this region, that China pulls itself out sooner the better. So there you go. These are the 5 things that hope that we can press upon you that were likely to happen. And please navigate around it and that you see fit. I'm sure you have some other things in mind that will happen in 2024. So be it. But this is roughly what we think would likely to happen. Of course, there is risk, right? The stubborn inflation we talked about. That it may not go down as much. You take a look at this chart, which I've showed earlier. You see this uptick. This uptick recently, you take a look, the orange line moves up. I know the green, which is the core CPI, is going down, which is great. Everyone looks at that, but you see there's a conflicting direction, and that's where the problem is. That's where the tug of war is. The Fed really hopes that eventually the orange line trends down to 2%, just like the core of CPI. So the thing is, the toughest part is we have to wait. We have to wait. We have to wait for this to pan out. But if it's stubborn, then there's a big risk, right? So if it's stubborn, which what it means that Fed will be harder, raise rates higher, pushing it really down. So not only that, there is ahead with presidential election, antagonism and other stuff. You don't want that to happen. If that happens, nasty thing happens during the election, then there is a risk to the performance of the stock market. Okay, so globally, same thing as the short-term risks: Russia, Ukraine, high commodity prices, China, US competition, climate, as a Middle East conflict. So I just pray and hope that the Middle East conflict will be contained. Doesn't look like it now. We have to wait for the next few months to see how it is. But let's hope it's quick and fast. But looking at, you look at for following Middle East, you know that it's not going to be easy, especially hold hostages. It's a bad thing. Hold hostages, human shield. Well, I'm glad we're not having to make those decisions, difficult decisions. Okay, so what should you do? What should you do over there? Again, this is a general conversation. Again, anything specific, please talk to your advisors. They're the best person to equip to match you exactly what you need. Because I'm going to speak generically, right? So what should you do? Well, very quickly, you should figure out that your 2023 performance is somewhat baked in. In other words, it's there already. There is no need to figure out where it's going to drop and all this about it. Why? Because set your mind further ahead. But you need to bear in mind the risk ahead. Okay, bear in mind the risk ahead. Those things. So it happens, it happens, and you probably have to decide. Maybe you want to put some money in and have some money hold back. Just these things come in, and then you will buy at the low. Maybe that's one way of doing it. So do not forget the US equity market is upward sloping trend. In other words, while there are risks and all those things, I tell you, it may be negative, but don't forget, in January it goes up. So don't miss the boat. In other words, don't miss the boat. So most of people, I think you should, and I would think it is a great idea to start positioning yourself for next year, which would likely, not will, but likely be positive in year 2024. Because in general, market goes sloping up. I have no time to explain why it slopes up, because those who have listened to me before, the very good reasons why it slopes up, and do position yourself for that. So that's why I wish you all a good end of the year. I will see you. I wish you all have a great Christmas, a blessed Christmas. Enjoy year end, take your leave and everything. Hey, Japan, yeah. Okay, so that's that. But prepare before you go for holidays, end of year, prepare for 2024, position yourself and everything. And we hope we pray for a good 2024. And of course, a good resolution to what's going on in Middle East. So that's it. Q&A time. I'm gonna stop share and I'll move on to Q&A. Um, and This is how we do it. I'm going to look at the Q&A segment. I'm going to answer it as it comes along. And when there is no more questions, that's where you stop for the day. And so I totally appreciate that for you. This 1 hour and 40 minutes already. So thank you all. 105 of you are staying in, and I see no dropout, which means okay, I'm making some sense. But feel free to comment if you need certain things that I'm not doing. Please let me know. And again, we'll go back to what I said earlier. Please ask your questions because I can never cover everyone's doubts, questions, and all. If there are gaps, like I said, please ask now. Let me take a drink before I answer. I haven't stopped for a drink for like 1.5. Yeah, 1 hour and 10 minutes. Yeah. Okay, I'm gonna answer the first question, which is, oh, by the way, if you don't mind, if there are no questions, we end early at 9 o'clock, fine. But if I answer before 9 o'clock, we all knock off early. It'll be great. So there are 4 questions now. Okay, I'll answer them as best I can. Again, hard stop is 9 p.m. So all of us can go back and rest. Um, if not, if I answer earlier, we'll stop earlier. Anonymous attendee asks, how big the risk to use investing in crypto to fight against inflation, since the government put many restrictions on withdrawal of cash from crypto platforms? Are there ways to fight inflation using crypto investing? That's a good question. You know what? I wish I see all of you in person. I wish I could ask you to raise your hands, see who's involved in crypto. It'll be good. Interesting. See how many of you, or it's 103 right now, which is still listening in. How many of you are in crypto? It'd be fascinating. But let me help you put a perspective. It's how we think. Crypto is not something that we think it is an asset. Now, let's say again, it's not an asset. It is, if I've got put it in a way that most will understand it, it is a commodity. It is something that it could be a specific interest type, but it's of value, certainly. So long as there are buyers and sellers for this crypto, there is a value. The problem is, it's not a big market. There will be a group of you who are totally sold on crypto, and you will maintain the value. The question is how many of these more people come in to agree with you, because there's a lot of people are moving out of crypto investing because of the crisis they're having in terms of integrity and all the issue, explosion and all the collapse and everything of crypto, and rightly so. Look, if you asked me last year or even in starting on crypto, I've never gone to crypto. Zero. Why? Because in my view, and the way I understand it, it's no different from the way we started commodities trading. When there are no rules, there will be greed. There will be no rules. The young people there in the cryptocurrency make up their own rules, and they are not experienced. They haven't gone through the same things that we older guys have gone through previously, because there's greed and there are a lot of things, there are pressures and so on and so on, and they will do things that otherwise a normal exchange wouldn't do, and therefore you have all this crisis. It's like that because it's not regulated. Anything that's not regulated, there's a reason for regulation. So sometimes people ask, oh, the fence is there. Why is the fence there? Let's take out the fence. But there are reasons for the fence. The reasons for all the fences are developed over time is because there were problems over time. Because of problems over time, the fences for us in terms of regulation, in terms of us investing in stocks or bonds, are all erected for our own good, because they need to keep the bad actors out of this environment that we are in, the investment ecosystem that we're in. So we are protected as best as they know, as the best we can, develop over how many years? A decade. So it's a long way. It's a long way to come and protect ourselves. And therefore, risk-wise, it's easier to invest in a regulated environment. So to answer your question, sorry, it took a long time to answer a question. Use crypto? The answer is no, because crypto, you can't even know the value up and down depending on the interest of being low. Right now, it's only Bitcoin and Ethereum, I think. It's more popular now. The rest is all gone, right? So of course, you'll find some people who are interested in here and there, but you believe you me, is no different buying penny stocks. Some people drive it up, and you get the wrong end of the stick, you lose money, that kind of thing. So, so to view crypto, hopefully in my mind, I can share with you my thoughts, is that view crypto as what it is, what it's worth. In other words, it's another person's value of the money, and then that's it. Whereas for stocks, it's got the underlying is the business. It's underlying is money coming in. It is real. You know that the value can be maintained. Even next guy come and say, look, we know the business is there, and that it's worth so much. It's not worth persons whims and fancies whether how much the company is worth. Let's say the company has 10 million and it's holding it there. Of course, the minimum someone pays 10 million for it, So things like that, So a little bit more sense, reason, less of sentiments or preferences in a stock which has got earnings versus a contrived value of a crypto. So I hope that helps. So to fight inflation, I know it's a big thing. To fight inflation, stick to the old game. The old game says that go for inflation hedging instruments. What are they? They are your stocks. They are your properties. They will ride inflation up. But can I say something about property? Property in general will ride inflation, but because of social impact of property prices, the invisible hand of government will come in and they will limit the upside. Say that again, it will limit the upside. So property price may not move as fast as you like against inflation. But that said, because of the artificial clamp down on a exuberant pricing of properties, it helps. What do you mean it helps? It helps because if when market softens for property, guess what? Because it's contained and compressed at the lower price for so long, even the natural unconstrained price drops. It probably drop at where it is right now. So in other words, it's very well supported in terms of property prices. If there is a government, so you ask me, about Singapore, should I buy? I said, of course. Will it go up? Not as much as before. Will it go down? I say unlikely because of all the rules. Singapore has done so well in terms of containing it. So that's where we are. So I hope it helps. So to your question, how we fight inflation, please stick to the standard rules, which is inflation hedging instruments, which is called equities and stocks. The simple stuff, stick to it. Believe you me, you will not be disappointed. Okay, so that's one question. Ooh, took a long time to answer one question. What's the outlook on China? I think I mentioned about it. Has everything. This is so opaque, we don't know, but they have lots of trouble. Okay, so that's a problem. And because of that's a problem, we have to wait it out. So it depends on you. How do you want to do it? You want to reset your thinking and all. Okay, so this is a personal management rule, is that when I see things wrong, I like to reset it. Reset it in terms of take losses. Yes, I'm sorry, take losses. Sometimes half, let's say half or whatever. You still want to cling on to the rebound, so be it. But you really got to reset your thinking about China. China is not what it was because the war now is real. The economy is splitting as we speak. But how do you invest in China, given the split and all? We have to see for dust to settle. Right now, it's not quite settled. But certainly in the West ecosystem, we understand better. So I hope that answers your question with regards to China's economy. Hope that helps. Okay, second question is by Joanne To. Says, what about time of Bitcoin and e-currency? Is there possibility of fundamental change in money markets in the next decade? Okay, welcome, Joanne. Welcome. This is so difficult, the question. Oh man, well, thank you. I'll try to answer. It's not easy. This will take half an hour to answer. But if I could tell you that e-currencies and Bitcoins are different. Say that again, e-currency. E-currency, can I equate it to currencies that are issued by e-currencies that are issued by central banks? So so that I define that e-currency I define as electronic money issued by central banks. Whereas Bitcoin is unregulated. There's no central bank behind it. Okay, so there's two types. So Bitcoin will be your, it'll be there, I think, because I think at the end of the day, when dust settle and everything, there'll still be people believing in Bitcoin because they're anti-establishment people, underground, all these people will love this. So they'll always be. So if you think that in the whole history of the world, there are bad people, then Bitcoin will be there because it's, it's untraceable of sorts, right? Nobody controls it. So Bitcoin will be there. If you invest Bitcoin, I personally think the value will still be there, although it fluctuates. E-currency different. E-currency will operate just like your normal currency. It's controlled by the central governments. They love it because they can track where it goes. You can't do what the money launderers did in Singapore, the few $1 billion you can't do that with e-money. You got to have normal money. So what's a possible fundamental change? E-currency could well arrive together with paper money or fiat money, we call it, so it'll be there. It will coexist. We experiment with it and we see how it works. Certainly, Bitcoin will be there by itself and always be the anti-establishment. All will be there. They will be around. So I hope it helps. All three will be around. I hope I answered the question, Joanne. Okay, anonymous attendee asked, with China experiencing deflation right now, yes, it's deflation, technical deflation, yes. How would it affect the global economy? Yeah, okay, for Europe, you can see it's affecting Europe for sure. Trade-wise, Singapore, we are affected as well. We are not growing as much as we like to because of the trade there. But Singapore's economy is slowly changing. We are moving into a bit more of the startups. In other words, a very interesting economy. It's not your usual. That's why I must give it to the government. They're quite good. They're trying to figure out all this, giving hope to all this, the fintechs and all this new economy come in here and start up business. You know how it works, right? In other words, people from overseas come, bring their money in Singapore, invest in these companies. Of course, they'll fail, right? Most of them will fail. You know that. Probably of successful companies are like entrepreneur companies are like what, less than 10% every time. So 90% will fail, 10% will succeed. But the whole idea is there's the economy going. Some people are willing to bring money out into Singapore, spend on these people, be employed, and when they're employed, they can spend and so keep the Singapore economy going. So all the whole stuff. There's an ecosystem in this whole startup thing. Brought in by money coming in from outside. With hope they find unicorns. So that's how it works. So we, in that sense, Singapore's got that expanded the part that the economy great. Because we don't really need to rely on the old manufacturing, finance. We, being a neutral country, we've been seeing a lot of startups in terms of family offices, and all money are coming in Singapore. Good, right? It employs Singaporeans at least, and spend here. Great stuff. So how we affect global economy? Most economy we affected. Singapore we affected, but those economy with a large internal consumption, like US, India, Philippines, Indonesia, all these will unlikely be affected. Okay, so I hope that helps. Okay, so to your question, what about outlook developing nations, those with a larger, which depends a lot more on domestic consumptions, they'll be likely unaffected. Okay, so what's a good time to enter the emerging market? Okay, I'm not gonna get there because emerging markets ups and downs, you really don't know what and when to get in and when to get out. So a good gauge is this, if you go in when it's low, go when it's up, just get out and wait for next time to go down and go in. Hope that helps. Because emerging markets are all across. And for us, usually when you speak about emerging market, I can imagine you thinking about Asia most of the time. So Asia, when it comes down, then buy, go up, please get out. That's emerging markets for you. My experience over 20 years, this is what it is. Over 20 years. What will the US impact market next year? Well, you will get data. You would get data that comes to tell you that every time after the US election, market will zoom up. Say it again. Every time after the US election, market will push up. You'll see this data for sure. October, November, you see fund managers come and tell you that. So that's why I'm telling you, prepare for this year. Position yourself this year. Don't waste. I know it's risky and all. I don't know, but just usually, probably market is going to be positive in its usual probabilistic sense that it will be positive next year. So there you go. It's all probability with all the risks. So I cannot paste all my risks in front of your face or in front of your eyes first. So just in case, just in case. Again, check your financial advisor before we're ready to do. Yeah. Okay, so Law Feng asks, oh, let's see what the law says. Okay, will you see will will you see that more US banks have financial problem like SV bank interest rate inversion curve? Oh no, it's gone. Law firm, it's over and done. If anything, you should have shown up by now. Because the regulators are checking the banks. It seems to be okay. So okay, it's over. The past event is over. Hope it helps. Next question. Anonymous attendee asks, after hearing your sharing, does it mean that a economic crisis is not bound to happen? No. Well, how to answer this? It looks like it. It seems like it. But again, it hedges very much on the battle between the interest rates and the inflation, right? So okay, so what happens if inflation is stubborn? What would you think? What's the next step of the central bank? Still push it down. And how do you push down? Raise interest out. And certainly there'll come the recession. But the thing is that we are dealing with the stock market, we're not dealing with the economy. So hope that when you put this aside, when we think about economy, we think about economy fine, but when we think about investment, we talk about market. The market has anticipation of the economy and beyond. The timeline is longer, scattered across time. So we are in a business investing, we look at the market, we look at how the market respond to expectation of economy and beyond. Yes, there can be recession. Yes, there will be economic downturn, but may not necessarily reflect on the stock market. I hope that understands. Because stock market looks beyond. Remember, I started the game theory. The game theory is like markets goes down. What do you think and if the inflation is contained, and what do you think the central bank will do? Bring it up. This it's like that. It's a game theory. It's all the playbook. It's clear because when playbook is clear, nobody wants to be the last one to sell at bottom because you know the next playbook. Next thing is that they drop the interest rates and therefore send the economy up. So hope if there's anything you want, one of the things that you can take away from here is that separate economic activities and market, stock market, how you invest, because stock market has got lots more factors in it than the economy. Hope it helps. Anonymous attendee, next question. Whoa, wait a minute, I'm on 8:57. And looks like I'm coming on the last few questions. So sorry, I know there are 12 open questions still. I apologize, I'm going to answer them all. But do my best. I'm going to try and answer this question. My anonymous attendee say, when you say that you expect market to be positive 24, this is referring to US market only. Okay, so thank you. But let me explain a little bit more. The benchmark that we use is MSCI World. Now, MSCI World in general occupies about 63, but tonight, as we speak today, about 62 point something, or we use the camera 63% of the component of MSCI World comes from the US market, and the rest roughly split between the Europe and Asia and the rest of the world. Okay, so hope that helps. So with that in mind, if the US market does well, you think the MSCI World will do well, given that US market is more than half of the MSCI World. So it's likely to do well, right? Unless the smaller components will crash so badly, pull down to 65 or 63%. Okay, so that's a big picture. Now, let me zooming down to 63%. The 63% of US contains of US companies, right? But can I pose you a question? All the companies in the US, those in S&P 500 are bigger ones, and they all draw their revenues only from the US. Do the top companies draw the revenue only from the US? I think you know the answer is no, right? In general, I get my numbers correct. About 40% to 60%, depending on the company, draws their revenue, at least the larger cap companies, from international revenues. About 40 to 60%, depending again on which company. So when you buy the US companies, usually you buy the world of stocks. So sometimes when you follow MSCI World, yeah, really about the world. So US do well, so the world do well, guess what? As long as the world population increases, as we all increase per capita per income per capita increases for the rest of the world, equity market should go up. I hope that helps. It's 8:59. Sorry, I want to answer this last question. How do you think countries reducing US dollars as a reserve currency will affect the US economy? And what do you think about multipolar world where can we no longer where US can no longer dictate the terms of trade? Okay, a good question. You're very forward-looking. I appreciate that. I'm afraid this question will you and us, all of us, will have to deal with it every year. Now, what I mean by every year, we have to deal with it every year because as we speak today, US is still the largest reserve currency in the world because of trade, right? You trade because US has got the strongest domestic consumption. We just absorb. I love it, because they're so strong. Economy is so strong. It's the largest economy in the world, and therefore I think this alternative. But that's the one small reason. The other reason, of course, is the police of the world, and because it's set the world started with English language. By the way, international language is English. Just to let you know, I know in United Nations all speak different languages to appease everybody, but by and large, most of them speak English. So too bad, if you're Chinese, Indian, Malay, whatever, unfortunately, our language will not likely be internationally spoken across the world as much as we like. I know Chinese trying to do that. Of course, the Africans would like to speak Chinese, but when Africa, at the end, you don't want to master one language, you want to master one language that speaks all throughout the whole world, and the whole world, including India, is English, right? So you can't just say China because India, what to do? But India's own language, right? So the unifying language, unfortunately, right now in the world, whether we like it or not, we're born with this time of world, it's called English. So as far as English concerned, which means that like in US, a lot of trades done US, therefore US dollar will be the predominant currency of trade for a long period of time. Now, does it mean that Chinese and the one will not erode it? Of course it will. Our first is starting already. To what extent it is? Well, I suppose at the end of the day, to extent of each other's domestic trade. So long and short of it is that see, the yuan isn't fully internationally a trade exchange yet, so you need to wait for the next step. So like say you revisit every next step. No, the yuan is not freely exchanged. And do you think the Chinese government will allow the freely exchange? That's a problem, right? If you want to control and you want international currency, a lot of issues. So I don't think the Chinese have thought it through comprehensively. I think they've thought it through. They're smart people, but because they have their political interests and economic interests, unfortunately, they can be creative, but right now I don't see how they can achieve what they want to achieve economically with the kind of political leverage they want to hold. Make sense? They still want to hold those things. So it's not easy for China to replace US as a dominant reserve currency. So as we speak to you, likely that it's going to be US for near term. So I think I think I'm comfortable with that. In a multipolar world, I'm sorry, there's no we have to live with that. We're already living with it. As you can see, we deal with China, we deal with US, and if I can say, I'd rather deal with US, not because of anything, because again, I'm helping my investors like you. We need to invest something that we want to be certain of we can take the money out, return to you. You know what I mean? So it's a whole lot of things. And the system of investing came from the West. As we know it, the stocks and bonds all came from the West. And system is well oiled. Because the system was well oiled, we'll keep to it. So Chinese one will try to look. Chinese just basically gave up on the foreign bonds, the foreign property bonds, and they go bankrupt and look domestically. They're willing to pay the domestic people. They're not willing to pay the. And so, what kind of trust do we have in Chinese international bonds? Oh, some bonds are gone. So China haven't figured it out yet. That's why I said they haven't figured it out yet. As far as I see, and to protect you, I would stick currently to the west and keep an eye on the east. So thank you very much. It's 9:04. I really appreciate all you guys listening. I'm again apologize for the rest of the 8 questions I can't rest of 7 questions I have not managed to answer. Do come in January because our topic is January next year, our next client seminar. And please key in a question first so that I can answer it with the first one, answering your questions. So you get your queries cleared. So thank you very much. I really appreciate your time. 1.5 hours. It's a lot of time. I hope you enjoy it. Thank you very much once again. Goodbye and have a good night.